Good day, everyone. Welcome to our webinar for February 2023. I hope you all had a great festive season, and I wish you all the best for this new year. We begin, as usual, in America, and on the screen you should be able to see the S&P 500 with the bear trend mark there and the three major rallies which have occurred in that bear trend. The new year in America was greeted with increased enthusiasm and optimism because of the December inflation figure from America, which came in at 6.5%. That means that inflation in America has now dropped for 6 months in a row. The Fed is seen to slow down its interest rate increases and even pivot and start reducing interest rates. We believe, however, that this may be a potentially dangerous illusion, despite the trend in the inflation rate. The inflation genie is still out there, and it's not so easy to return it to the bottle. The Fed has persistently underestimated inflation, and its responses have been late in the past. Core inflation, which excludes food and energy, was up 0.3% in December 2022, and now stands at 5.7%, still well above the Fed's target of 2%. Economists in America and around the world are predicting that the US economy will enter a recession this year. That means, of course, 2 consecutive quarters of negative GDP growth. Over the Christmas period, I had the opportunity to read Nouriel Roubini's book, Mega Threats, and I recommend it for your reading. He identifies 10 major threats to the world economy, and I believe at least some of those mega threats may occur during this year of 2023. By last Friday, about 29% of the S&P 500 companies had reported on the fourth quarter. That's the December quarter last year. 60% of them had their revenue up above what was expected, and 69% reported earnings above expectations. But you must remember when thinking about this, that the expectations were low. In fact, actual earnings fell by 5%. The largest year-on-year decline since the third quarter of 2020. So this is quite significant. The actual earnings dropped by 5%, and that's quite a big year-on-year decline. S&P profits are obviously falling, and analysts' expectations are falling along with them. The 12-month forward PE of the S&P 500 is now 17.8, and that is below the average of the last 5 years, which is 18.5. Retail sales in December fell by 1.1% after November's fall of 1%. So this is the largest single-month fall in a year, and 10 of the 13 categories of retail sales fell. Factory output was down 1.3% due to a fall in business equipment production. Petrol sales were down 4.6% despite lower prices. The US economy is clearly beginning to respond to the aggressive interest rate hikes and quantitative tightening that the Federal Reserve Bank has been doing. Consumers are beginning to take some strain. Despite this, the economy created 223,000 new jobs in December month alone, well above the expectations of economists, which were around 200,000 jobs. Unemployment also fell. The unemployment rate fell back to 3.5%, which is pretty close to full employment from where we stand. At full employment, we would expect wages to start going up, and indeed there is upward pressure on wages. So the tightening policy of the Fed has not yet impacted on the employment situation despite the rapid increases in interest rates. Of course, the Fed is producing a decision today. They will decide today, the Monetary Policy Committee, on what to do with interest rates, and it's widely expected that they will increase rates by 25 basis points. Of course, that is well below the 75 basis points of the last 4 rate increases, and is generally perceived to be a softening of the Fed's stance on interest rates. There is an outside possibility of a 50-point hike. If that happens, that will send the S&P tumbling. But the United States still has negative real rates of interest. In other words, the rates of interest are still lower than the inflation rate. And this means that there is no real incentive to save, only to spend. Rising interest rates increase the incentive to save, but it takes time. It takes time for people's perceptions to change. In our view, the US economy is definitely heading into a recession, probably a severe one. And that will be caused by this pattern of rising interest rates. We think interest rates will continue to go up, perhaps a little bit more slowly and more cautiously, but they will continue to go up, and we believe that they will stay up for quite a long time until consumers slow down their spending, and that could be well into 2024 or even beyond. Of course, the oil price is a major factor. If we look at the price of Brent oil, I'll just put that chart on the screen for you. Here you can see Brent. I just want to pull a bit more data in so that we can get a little bit of a better picture. There you can see the decline in the oil price as a result of COVID-19, and then subsequent to April 2020, we had this continuous upward trend culminating in the Ukraine war in March 2022, and that's, of course, spiked oil prices up. And then, of course, you may recall that Biden visited with Saudi Arabia in July, and since then, oil prices have been in a downward trend. Recently, the last month and a half or so, oil prices have ticked up a little bit, but in our view, they are still in a downward trend. So oil is a major factor. There are 23 oil shares on the S&P 500, and they have a collective impact of about 5% of that index. They, of course, had a great year in 2022, but will probably not do quite so well in 23. Okay, let's go back and look at that S&P chart. Here you can see what I've done with this chart. The thick black line here is the bear trend, and you can see it starts there from the record high of 4796 on the 3rd of January 2022, just over a year ago. We had the first rally, which identified the support resistance level here at 4170. That was confirmed here again by a mini rally, and then later on, that is stuck in as a support or resistance level. You'll notice that we have declining tops, so that was the peak, the second top, the third top, and now we're in the process of creating a fourth top, which is turned into a triple top, actually, as you can see from these red circles which I've identified here. Note also that I have a 200-day moving average on this chart, a simple moving average in the blue line, and then I have a 50-day exponential moving average in this black line. The reason I have those two particular averages is because they are part of what is called the golden cross. When the black 50-day exponential crosses over the blue 200-day line, then you have a golden cross buy signal. And that is quite widely followed in America. A lot of people will take that as meaning that Wall Street is now again in an upward trend. And you'll see that as of last night, that golden cross looks very, very imminent indeed. At the same time, last night's 1.5% up move in the S&P 500 took it up to this trend line. And the third occurrence of this triple top. However, we believe that it will probably fall back from this. Note how the festive season, the sideways market during the festive season, that's associated with very thin volumes on Wall Street and should not really be a significant factor. So what we're looking at here is the top of the third rally, and this extended top, probably mainly due to the festive season. We expect it to fall back from this level and to continue with the bear trend. Of course, one of the major factors that came through yesterday and that caused the market to go up by 1.5% on Wall Street was the General Motors results. They had a very good fourth quarter, and that resulted in a 7% jump in the share. Spotify also, another American company which you may know of, jumped 10.3% on increased subscriber numbers. Exxon, McDonald's, and Caterpillar were down, but it resulted in this top that we are looking at on the chart there. All right, so that's where the S&P 500 stands right now. You must remember that trend lines, like this big, thick black line here at the top, are not an exact science. They are variable quite often. The more touch points that they connect, the more reliable they become, but they are certainly not an exact science. Today, the Fed will announce what it's going to do, and it's expected to be putting interest rates up by 0.25%. Anything more than that, or even a negative speech accompanying that, will probably result in a sharp sell-off of shares on Wall Street. Excuse me. So we believe that the bear trend will reassert itself. The S&P looks now to us distinctly overbought at current levels. There's a growing awareness that the economy is moving into recession. We believe that that recession will turn out to be deeper than expected, and interest rates are unlikely to begin falling anytime soon, and the bear trend will probably gain some momentum. As it gains momentum, the optimism which has been a constant feature of this bear trend will begin to disappear. There are still far too many small players in the market, all of whom are too bullish. The bear trend can only really end when we reach a point of capitulation, where the bulls literally give up. That's what capitulation means. So we are expecting the S&P 500 to come down from these levels and to break this low here of 3577 made on the 12th of October last year, and to find a new low somewhere below that. All right, so that sums up more or less what I think about the American situation, the S&P 500, which of course the other markets of the world tend to follow, including the JSE. Just want to spend a few minutes talking about Ukraine. There have been some significant changes in Ukraine. The decision by NATO countries to send tanks to that country to help it with its war effort is very significant. In fact, we believe it's probably a major turning point. Germany is sending Leopard tanks, the UK is sending Challengers, and the US is sending Abrams tanks. Other European countries like Poland are also sending tanks. In fact, Ukraine says that it now has pledges for as many as 321 tanks from various different countries. Of those, probably only about 120 will get there in time for the spring-summer offensive, which Russia is said to be planning. But this incursion of armor into the Ukrainian armed forces will certainly help them to oppose the spring offensive, and then in time, obviously, also to begin an offensive of their own. In fact, we expect that by late summer, somewhere around August, September, Ukraine will have gained ground. In other words, they will be conducting an offensive of their own. Zelensky, of course, is now asking for fighter jets to complement the tanks that he's being given. And obviously, air support is very important for tanks. We all know that. The additional equipment may even make it possible for Ukraine to take back Crimea. If and when that happens, we believe that Putin will not survive it. He will not survive it politically. The worst thing for a dictator or a would-be dictator is to be perceived as a loser. And I'm sure Donald Trump will confirm that fact. It's much worse than being a liar or a cheat or a thief. All those things are acceptable, but to be a loser, that is not acceptable. All right, let's turn our attention now to South Africa. President Ramaphosa presented his speech at the ANC's annual celebration on the 8th of January. It was full of all sorts of promises that we South Africans have become very wary of hearing. We've had so many unfulfilled promises. Ramaphosa, who began with such hope at his election in 2018, seems to have done very little. The ANC still seems to be dogged by infighting and corruption, and the country, of course, is paying a high price. Recent polling suggests that the ANC would win less than 40% of the vote if it was conducted today. What are the chances that that percentage will improve before the 2024 election? That's only 18 months away now. We don't believe much will change. If anything changes, they'll probably become less popular. Ramaphosa himself is quite popular. It's the ANC that is losing ground. A strong voter backlash to stage 6 load shedding is to blame, I think. The DA's well-supported march to Luthuli House in Johannesburg, led by the DA leader himself, it was a very unusual march because there was a combination of middle-aged white men and thousands of black people in that march. Quite an unusual sight here in South Africa. So we believe that the ANC will lose its parliamentary majority in 2024. We think they will be lucky to get 40% in that election. And that will force them to seek some sort of coalition, almost certainly with the DA. And the DA will want something substantial in return. We would suggest to them that they take the Department of Minerals and Energy. In the long term, such an alliance could be very good for South Africa. Ramaphosa, of course, is still contemplating a cabinet reshuffle, so we hear. The question is, will he have sufficient political power to get rid of Gwede Mantashe, our Minister of Minerals and Energy Affairs? If he can, that will be a big step in the right direction. All right, let's look at the economy now. President Ramaphosa, of course, managed to retain his position at the NEC's elective conference in December, and that's a big feather in his cap. It has resulted in an improvement in the international perception of South Africa. We're now seen as being politically stable, at least until the 2024 elections. And I think that has resulted in a net inflow of capital after 2022's outflow. The yield on our 10-year bond is now about 10.5%, a good 7% above US Treasury bills, and of course now even more attractive with better political stability. Inflation in South Africa in December was 7.2%. That's down from November's 7.4% and October's 7.6%. And we may well be past the worst of the inflation in this current trend, especially if the downward trend in oil continues. South Africa's Monetary Policy Committee hiked rates by 25 basis points at its most recent meeting, staying well ahead and anticipating the US Monetary Policy Committee's decision, which will be out later today. We have been consistently well ahead of the trend in interest rates, and this is due to the continued vigilant and responsible efforts of our Reserve Bank. Christmas retail spending went very badly. It was affected by the sharp rise in load shedding. Consumers cut back in order to afford alternative power solutions, to get away from Eskom to whatever extent they could. Rising fuel prices and interest rates also had an impact. So Christmas 2022 will go down as one of the worst on record. The BankServe take-home pay index showed that workers' pay dropped by 4.8% in December. So the workers were much worse off in December than in 2021, especially with inflation at 7%. Average industrial action settlements came in at below inflation at 6%. And all of this is feeding into the general discontent with the government and the ANC. Company liquidations were up more than 30% in December, mainly a result of load shedding, we believe. The National Small Business Chamber pleaded with the government to offer small businesses some support. Manufacturing production. There was a bit of a recovery there in that industry or that section of the economy after the Natal floods. Mining production was down 10.4% in October, then 9% in November. Obviously, a lot of that is caused by the poor logistics from Transnet and also some from the lower demand for commodities. In October month, platinum group metals fell 32.5%. That's our production of them. Diamonds were down 22%, manganese was down 10%. In November, platinum group metals were down by another 22%. Mining and smelters use about 30% of Eskom's energy, so they have been heavily affected by this load shedding. And also, of course, they will be negatively affected by the 18.65% tariff increase which has been approved for Eskom. Coal exports in 2022 were dismal. Only 51 million tonnes were exported. This compares with 2017 when we exported 76 million tonnes. And of course, all of this is going on while coal prices are at record high levels. Cable theft, strike action at Transnet, a train derailment, all of these things resulted in Transnet declaring a force majeure and being unable to complete their contracts. The trade surplus, South Africa's trade surplus, fell to 233 billion in the third quarter from the second quarter's 252 billion. The terms of trade have been slowly worsening as the commodity boom tails off. Gold exports were down 12.6% due to lower prices and reduced demand. The fall in oil prices shows the weakness in the international economy. Oil has fallen from $125 a barrel in March 2022, last year, to current levels around $84 a barrel. We believe it will continue to fall, which will obviously help South Africa both with its inflation and, of course, also the petrol price. Two bright spots in the South African economy. Vehicle sales were up 14% over 2021, and they are now just below pre-COVID levels. Cars and commercial vehicle sales were up 16% in December 2022. This shows that the economy is still performing despite load shedding. Vehicle exports in December 2022 were also up nicely by 24%, and that brought the whole year up 18% over 2021. There's been some switching away from luxury vehicles towards cheaper cars, but the figures are surprising given that the Toyota factory was closed for 4 months because of the flooding in Natal. The other bright spot, of course, is agriculture. We've had 3 consecutive years of good rainfall, and that has boosted tractor sales. In fact, in December 2022, sales were up 17%. And agriculture, of course, employs about 900,000 people and contributes about 3% to GDP. It also has the effect that millions of poor people in South Africa who rely on growing an acre or so of maize were able to grow their mealies to feed their families, and that reduced their reliance on handouts and government handouts as well, and obviously charity. Okay, let's look at the rand. Just take a quick look here at the chart. Put the chart up on the screen here. So I'm just going to put 5 years data. No, that's too much. Let's go back to 1 year. Okay, here you can see that the rand has been weakening since April last year in a steady weakening trend against the US dollar. That came to an abrupt end in October last year, and then we had a period of strength followed by some sideways movement. Now it looks like we're heading into a new period of weakness, and I would suggest to you that this weakness is coincidental with the topping out of that third rally on Wall Street. So there's some anticipation of a shift towards risk on, which, as you know, makes investors, international investors, withdraw their funds from emerging markets like South Africa and take them and put them in US T-bills, and that results in a weakening of the rand. So the rand is now at about 17.42 to the US dollar, and we think it's because investors are anticipating a sharp fall-off in Wall Street at this point. Okay, just let's look at Eskom quickly. Of course, getting rid of Andries de Ruyter as CEO of Eskom will almost certainly make things worse there. He is just a scapegoat for the ANC's corruption and incompetence. And SA, South African citizens are waiting for the new appointment of a new CEO with some trepidation and resignation. Director's going may be part of the deal that Ramaphosa made to stay in office at the NEC meeting in December. And of course, he was provoked by Montashe's unsubstantiated public allegations of treason. Together with the retirement of the Eskom COO, the Chief Operations Officer, in April, it's going to make Eskom a very difficult place to manage. The shift to stage 6 load shedding is hammering consumers and businesses. Eskom is being reduced to a backup service as business shifts away from relying on it and tries to get away from its price increases. A good example is Kaap Agri, which this month was talking about its installation. It's installed 2 solar power systems in the Western Cape at its outlets, and that was like an initial test. It's gone very well. Each of those systems cost about 1.6 million rand, and now it's planning to roll out the same system throughout the country at all its outlets. Cape Town City is now looking at using the new permission that it's got to buy power from independent power producers to get away from Eskom completely. Already it can avoid, with its current additional power, it can avoid 2 stages of Eskom's load shedding at any point in time. And that's a big boost for residents there and businesses. It's basically leading the way and demonstrating that the DA's ability to manage power effectively in South Africa. Of course, Gwede Mantashe, our esteemed Minister of Minerals and Energy Affairs, came up with a solution to the power crisis. He said we must buy power from Car Power Ship. We must also buy from neighboring countries. We must repair our coal-fired power stations. And we must address Eskom's skill shortage. That is his solution, those 4 points. He makes no mention whatsoever of renewables as a part of that solution. He, in fact, is the primary problem in South Africa's power supply. All right, let's look at some shares, some companies. What is interesting to us is that the JSE overall index made a new all-time record high on Friday. I just showed to you, there it is there. That's a new all-time record high. And it's interesting to speculate whether that means that the South African stock market will not be following Wall Street when it goes into a new downward trend. We just want to point out a few things about that. In the confidential report of the 1st of June last year, we advised people to buy process shares in order to help them to cope with the situation. Now, Process, as you know, it's a South African company, but it's listed in Amsterdam. And just put 2 years data on the screen here. Maybe just expand that a little bit more. Okay, so here you can see Process. I'm sorry, I'm just taking it out a little. We advised clients to buy Process shares actually over here when it was 756. Since then, it's gone up quite nicely. It's now trading for about 1,388 Rand, and it's risen by about 76% in 8 months. At the time, it was oversold, and you can see here, I made a note here on the chart that it had found support at 690 Rand a share, so it looked like good value to me at the time. And of course, it's one of the reasons why the JSE overall index is reaching a new record high, because Process, together with its parent company Naspers, account for a very large percentage of the JSE overall index, and both of them are going up very strongly. Okay, let's look at Tiger now. Tiger Brands is an iconic South African blue chip share. It's been around forever. I just want to go to 5 years, I think, and then maybe just bring in a bit more data here. No, bring in a bit more. Okay. What you can see here is, actually, you know what, I'm just going to use the zoom feature to put a zoom box around this a little bit. Start from there and go down to there, okay. and then go left. All right, so what you can see here is the peak of Tiger Brand's share price. And it was marked by a very convincing head and shoulders formation, which you should be familiar with. And you can see that before this head and shoulders formation, if I put all the data on the screen, what you'll see is that the share had been going up forever until we had that head and shoulders formation over here. And that head and shoulders formation was, of course, created or happened because of the listeriosis crisis that they went through, where we had an outbreak of listeriosis, very dangerous illness, and it killed 200 people in this country. And that is what caused this huge downward trend in Tiger. But before that, Tiger was a very well-known, top-class South African blue-chip share. It was associated with fantastic brands like Jungle Oats, Tastic Rice, Koo, All Gold, Albany Bread, Purity, Renown, Oros, Five Roses, Black Cat, and Fizzer. All those are Tiger brands. And from its start on our database in February 1985, that's the first price we've got for it, it's been a reliable generator of profits and growth up until its peak, which was on the 25th of January 2018, here, right at the top here, when it peaked at 474 Rand 50 cents. Remember, the first price we have for it on the 28th of February 1985 was at 3 Rand 95. So over that period of 33 years, the share went up 120-fold. And all that time it was paying out regular dividends and producing great profits. The listeriosis crisis, together with COVID, took the share down to 140 Rand from 474 Rand. It fell to 140 Rand. The crisis, of course, began in July 2017, and it was confirmed that the listeriosis came from the Tiger Brand's Polokwane factory on the 4th of March 2018. These dates are important. More than 200 people died, and the head and shoulders formation came about. What's interesting to note is that the peak of the head and shoulders formation occurred on the 25th of January 2018, about 2 months before Tiger was officially blamed for the listeriosis crisis. The right shoulder here peaked on the 22nd of February of 2018. So that's very important, because that shows that there was some insider trading. A big shareholder, or one or more big shareholders, were offloading their shares, caused this head and shoulders formation to occur, and they were gone long before this thing broke to the downside over here in March. So you can see this break here is where a public announcement was made that they had traced the listeriosis to that Polokwane factory. If we come closer to today and we look at the situation now, we have been talking about this share for a while because we believe that it broke up here through its downward trend line, and we drew this to your attention. And in fact, at that time it was 154 Rand, and it's since risen to 208 Rand. So it's done pretty well since then. They've also bought back about 1.5 billion Rand worth of their own shares, and their dividend this year is 18% up on last year. In their financials to the 30th of September 2022, revenue was up 10% and headline earnings per share were up 51%. So we think that this share is going back towards regaining its blue chip status, and that's why we are drawing it to your attention now. The next share I want to look at is Richemont. Richemont, of course, again, is an iconic South African company. It's now the world's second largest supplier of luxury goods. It's known for its brands, Mont Blanc, Cartier, Lancel, Van Cleef, Piaget, things like that. In its results for the 6 months to the 30th of September 2022, sales were up 24% and profits were up 40%. It's got a net cash position of 5.5 billion euros. And as you can see from the chart, it's in a strong, steady upward trend, and we think it's got some distance to run. BHP Billiton, it's an enormous commodities company. As you can see here, I just want to put a lot of data on the screen here. This is the whole chart from beginning to end that I have. So it starts in 1997, and you can see that there's the 2008 subprime crisis. This is the commodities boom, which began in January of 2016. There's COVID-19, and you can see we're at an all-time record high right now. But this is a massive company involved in minerals, oil, and gas. It has 62,000 employees, mostly in the Americas, North and South America, and also in Australia. It's very diversified. In its results for the year to the 30th of June 2022, revenue was up 14%, headline earnings per share are up 54%. And the long-term chart shows a steady upward trend. This is about as stable and reliable as you can get with a commodities company. Next share that we want to look at, Truworths. This is one of our favorite companies, clothing, footwear, and accessories. It sells those products in Southern Africa and also in the UK. About 70% of its sales are made on credit, which is important because credit management has to be very good. It's also in a very competitive environment, both with local clothing and accessories suppliers as well as overseas brands like Cotton On and so forth. It's dependent on a very accurate assessment of fashion trends. There's no point in them getting a whole lot of clothes in their store which are thought by consumers to be out of fashion. So they really have to be ahead of that trend all the time. They've got 767 stores in South Africa, 132 stores in the UK, Germany, and Ireland, and they've got a scattering of other stores in Africa. In the 26 weeks to the 1st of January 2023, retail sales were up 13.7%. We suggested waiting for a break above the trend line. Just put more data on the screen here. There you can see the trend line. The breakout eventually came. And that came on the 4th of September 2020 at 3195 cents. It's now appreciated to 65.95, and it still looks like good value to us. Okay, another company which has just come onto the market is Outsurance. Well, it hasn't just come onto the market. Of course, it is what is left. It is the remains of RMI, or Rand Merchant Insurance, after all their other interests have been stripped out. In effect, it is a new listing. Still being digested by institutional fund managers. It's done a trading update for the 6 months to the 31st of December. And it published the figures that it published showed that it benefited substantially from UE's profits, also from increased premium income and a decline in perils claims. Earnings are expected to increase by at least 20%, excluding Hastings. The share price has been rising steadily, and we like it. We like this share. Clicks. This is an old favorite of ours, diagonal share. A very important share, I think, for anyone in the private investor business. Here you can see how the share's been going up, but in the last, really since about the end of October, so November, December, and January, for the last 3 months, the share's been going down. And this is why I wanted to draw it to your attention. It's actually come off about 20% in this downward trend here. And the trading update that it just produced for the 20 weeks to the 15th of January was very good. Turnover was up 7.8%. Retail sales were up 12.2%, excluding vaccinations. But it's now on a PE of 25.7. And normally it trades on a PE of around 30. So we think it will probably go back up there fairly soon. And if you have been interested in getting into Clicks at some point and holding these shares for the long term, which is what we would advise you to do, then this could be a good opportunity. You should certainly look at the share. Anyway, folks, that's about all I have for you today. I hope that you found something there of value and of interest. Don't forget that I will be talking to you on the first Wednesday again of next month, of March. So make a note in your diary about that. Otherwise, thank you very much for listening to me.